Welcome to the Deep Dive. Today we're going to tear down the facade of the stock market. We're looking past the tickers and the charts to expose the unseen architecture, the physical reality of a system that most people think of as, an abstraction.
It's a great point, because our mission today is to really understand how technology didn't just change the U.S. stock market,
Yeah.
it completely reinvented it. And in doing so, it created a system that a lot of professionals realized was, well, systematically rigged.
And rigged is a strong word, but it's the right one here. We're talking about a system governed by fiber optic cables, computer racks, and literally the speed of light.
We're tracing that transformation from, people shouting on a trading floor human speed to a system that operates at machine speed. And we're going to explore what happens morally and economically when speed becomes the only thing that matters.
So we have to start with the origin story, because that chaotic human trading floor, it didn't just vanish. It was sort of slowly killed off, really out of a fear of failure.
Right. You have to go back to October 1987, Black Monday, the massive market crash.
Pivotal moment.
Absolutely pivotal, because it showed that when the system is under extreme stress, the human element becomes a liability. That classic image of brokers working the phones, shouting orders,
The one we all have in our heads.
that image was just shattered. Because when the panic hit, those same brokers, they just stopped answering their phones. They were completely overwhelmed.
So the human system basically failed. It discredited itself. And the official response wasn't, better training or ethics reform.
No, not at all. The response was to find a replacement for the unreliable human. They started changing the rules, which set in motion this slow, unstoppable march toward automation. Computers went from assisting traders to, well, eventually running the whole show.
And that's the key, isn't it?
Yeah.
Our market structure completely evolved, but our collective mental picture of it, it never caught up.
It's a comforting illusion, the floor of the NYSE, but it masks a reality that is so complex and it's been intentionally obscured. The people who profit from the complexity have absolutely zero incentive to explain it to you.
Right. And that shift to automation, to digital trading, it introduces the core problem we're digging into today. Because now the market is subject to the laws of physics: light, distance, time.
And when competition gets fierce, and the only way to get an edge is to be faster, what happens? You've created a system where the sole differentiator is, well, microspeed.
You move from human reaction time seconds maybe to algorithms fighting over nanoseconds.
Exactly. And that change happened so fast, it created this massive knowledge gap. The people who understood the physics of this new market, the physical location of a server, the exact route of a fiber optic cable, they suddenly had a huge structural advantage over everyone else.
Okay, so let's put a human face on this. To understand what this felt like from the inside, we need to talk about Brad Katsuyama.
Right. Brad was a trader at RBC, the Royal Bank of Canada. He was a smart, analytical guy, the golden child of his department. And crucially, he fundamentally believed the market was fair.
He was the kind of person who thought you could succeed on Wall Street without, being a shark.
Mm.
He trusted the system.
And that trust, ironically, is what made him so vulnerable. His education in the dark side of the market really started with a corporate acquisition.
This is such a great part of the story. It's late 2006. RBC, which is known for this polite Canadian no-asshole rule culture,
Right.
they buy an electronic trading firm called Carlin Financial for $100 million.
Boom. An immediate, spectacular culture clash. The RBC guys are polite Canadians. The CEO of Carlin, a man named Jeremy Frommer, was the absolute opposite.
I mean, we're talking about a guy who reportedly swung a baseball bat around the office.
Yeah.
Just pure Wall Street machismo.
And he had that famous quote that tells you everything you need to know about the culture they were importing. He said it wasn't enough for him to fly first class. He had to know his friends were flying coach.
Wow. It's pure dominance. It's not about shared success at all.
Not in the slightest. And with that culture came this supposedly state-of-the-art trading technology that RBC had just spent $100 million on. Brad was skeptical from day one.
And for good reason. Frommer gives this ridiculous demonstration of the platform's speed. He gets the RBC team around a monitor and says, trading is all about speed now.
Right. And to prove it, he has an assistant type in a stock ticker and hit enter. And the stock's name just pops up on the screen instantly.
And Frommer is beaming, right? He's looking at Brad like, see? See how fast that was?
And Brad just looks at his watch. It's 5 o'clock in the afternoon. The market had been closed for hours. The whole demonstration was completely meaningless.
It's absurd. Brad's immediate thought was, I don't believe this. He realized Either Frommer didn't understand how dumb his own demo was, or worse, he was so arrogant he just assumed the RBC guys wouldn't notice.
And that arrogance was masking some really fundamental flaws in the technology, and those flaws started to eat away at Brad's actual job.
Which was a huge job. He was in charge of providing liquidity. That means buying massive blocks of stock, say 3 million shares of Intel, and then carefully selling them back into the market.
To do that, to manage that kind of risk, you absolutely have to trust the prices you see on your screen.
But by the spring of 2007, that trust was gone. The screens had become an illusion. He'd see an offer for 10,000 shares of a stock at, say, $22.
And the second he pressed the buy button, poof, the offer would just vanish, not just move. It would completely disappear.
So he can't execute trades, which means he can't accurately price his risk on these huge blocks of stock. His whole business model is breaking down. He's paralyzed by the system.
So he goes to the developers, the tech guys who built the system. They were called the golden goose inside the bank because, they were seen as these untouchable geniuses.
And their first reaction is just to dismiss him.
Total blame shifting. Oh, it's user error. The market data is slow today. You don't understand how fast the market is. They basically treated him like he was some old-timer who couldn't keep up.
They kept saying the vanishing orders must be a reaction to some kind of news hitting the market. But Brad's question was simple and logical.
Why does the market for a stock only vanish at the exact nanosecond that I click my mouse? Is the news always perfectly timed to my trades?
Which leads to this incredible demonstration he sets up. He gets the developers in a room. They're all watching his screen. There are offers for 100,000 shares of AMD stock across all the different exchanges.
And Brad, to show them the timing, he literally counts down out loud before he hits the buy button.
He goes 1, 2, 3, 4, and right on 5, he clicks.
Boom. Instantly, all 100,000 shares offered for sale disappear. Every single one. And the stock price immediately ticks higher.
The developers were just silent.
What could they say? The logic was undeniable. And that's when Brad delivered that transformative line. He said, you see, I'm not reacting to news. I am the event. I am the news.
His own order was being weaponized against him. Someone was seeing it, broadcasting it, and exploiting it before it could even be fully executed.
They had confirmed the market was rigged. They just didn't know how or who was doing it.
So that's the big question. How does an order, a fraction of a second after you press enter, become public news that can be exploited across more than a dozen different physical locations?
The answer is all in the physics, distance, and the incredible value of time. We're talking about microseconds now, a millionth of a second.
Just for context, a blink of an eye is about 300,000 microseconds.
Right. So the things we're about to describe are happening hundreds of times faster than you can blink.
So why? Why spend millions of dollars for a microsecond advantage? What's the prize?
It comes down to arbitrage. Specifically, arbitrage between two geographic points, Chicago, where futures contracts are traded, and New York, New Jersey, where the actual stocks are traded.
The S&P 500 futures contract in Chicago versus the 500 individual stocks in New Jersey.
Exactly. And thousands of times a day, for just a flicker of a moment, those prices get out of sync. The futures contract might be worth a tiny bit more than the sum of the stocks, or a tiny bit less.
And if you can buy one and sell the other in that instant?
It's a risk-free profit, pure arbitrage. But you can only capture it if you can execute trades in both cities basically simultaneously and faster than anyone else.
Before the mid-2000s, the fastest connection between those two hubs was a telecom route that took 14.65 milliseconds. Traders called it the gold route.
And if you were on the gold route, you made money. It was that simple. But 14.65 milliseconds in this new world was an eternity. People knew that if they could just shave a tiny bit of time off that, they'd make even more money.
Which brings us to Dan Spivey and Spread Networks. This is one of the most audacious projects in financial history.
It really is. Spivey realized that if he could build the single fastest, straightest line possible from Chicago to New Jersey, he'd have a monopoly on time itself. He could charge whatever he wanted.
So he gets Jim Barksdale, the former CEO of Netscape, to fund a $300 million project. Not to lease lines, but to physically dig a new 827-mile-long tunnel for a fiber optic cable.
Their motto for the project was, the straightest path allowed by law. Think about that. They had to cut hundreds of miles off the old, winding telecom routes.
They're going under rivers, through private parking lots, blasting through mountains in the Alleghenies.
All for one single, incredibly specific goal. To cut the round-trip travel time from Chicago to New Jersey down to 13 milliseconds. That 1.65 millisecond difference was worth hundreds of millions of dollars a year.
That is just insane. And the price to get on this new speed highway.
To lease a single shovel, which is just 2 strands of glass fiber in that tunnel, cost $14 million up front.
$14 million just for access. I mean, that price alone proves the market is fundamentally broken, doesn't it? It confirms the game is no longer about investing, it's about who gets there first.
It absolutely proves it. The profit was in the infrastructure, not the analysis. And it also meant that Wall Street had physically moved. It wasn't in Manhattan anymore. It was in anonymous data centers in New Jersey, places like Nutley, Mahwah, and Secaucus.
And this is where Ronan Ryan comes in, the boxes and lines guy.
Yeah.
He understood this new physical map better than anyone.
Ronan worked for a company called BT Radians, and his job was to convince the big banks that they needed to co-locate.
Co-location, which basically means putting your trading computers in the exact same building as the stock exchange's main computer.
Right next to the matching engine that actually executes the trades. The closer you were, the faster you were. And proximity mattered down to the foot. People paid fortunes for a server rack that was 10 feet closer to the matching engine.
Ronan tells these amazing stories about the paranoia this created. The traders kept their servers in locked cages inside these data centers.
And he talks about one firm's cage that was covered in old Toys R Us logos, and they refused to take them off.
Why?
They thought it was camouflage. They believed the logos would disguise their physical position in the room so their rivals wouldn't know they'd secured the absolute best, fastest spot.
It's incredible. It's like high-tech finance meets primitive superstition.
It is. And Ronan felt like he was just the getaway driver in all this. He said they were always telling him, drive faster, drive faster. Then it was, get rid of the airbags, get rid of the seats. He was building these super highways, but he had no idea what kind of crime they were enabling.
But his knowledge was the missing piece of the puzzle for Brad. Ronan confirmed that the U.S. stock market had become a class system based entirely on speed. The haves paid millions for nanoseconds, and the have-nots, which was everybody else, were completely in the dark.
So now we understand the physics and the speed. But speed by itself isn't illegal. It only becomes predatory when it's combined with a specific regulation.
A regulation that forces investors to be vulnerable.
Exactly. And that regulation is called Regulation National Market System. Reg, NMS, passed in 2005, implemented in 2007. It's the root of the whole problem.
It was designed with good intentions, right? It was meant to help the little guy.
It was. The core idea was to protect the National Best Bid and Offer, the NBBO. It meant that if you wanted to buy a stock, your broker was legally required to get you the absolute best price available anywhere in the country.
Sounds great on paper.
It does, but the fatal loophole was in the execution. Because the stock market wasn't one place anymore. It was 13 or more different exchanges in different cities. So to get that best price, your broker had to travel to all of them.
Let's use an analogy here. Let's say you need to buy 10,000 apples, and the law says you have to get the lowest price.
Okay.
And there's one store, Store A, that's selling 10 apples for 99 cents. That's the best price. The other 12 stores are all selling their apples for $1.
Right. So Reg NMS forces your broker to go to Store A first and buy those 10 cheap apples. But to get the other 9,990 apples you need, they now have to physically travel to Store B, Store C, and so on.
And that travel creates a time cap, latency.
It creates the window of opportunity. The high-frequency traders, the HFTs, they are co-located right next to Store A. They have their $14 million fiber lines. When your big order for 10,000 apples first hits Store A to buy those 10,
That's the signal.
that's the signal. The HITs see that tiny purchase and their algorithms instantly deduce a big institutional buyer is in the market for apples. So they use their speed advantage to race ahead to stores B through M and buy up all the dollar apples before the rest of your order gets there.
So by the time my broker's order arrives at Store B, the price isn't $1 anymore. It's $1.01. Because the HFTs have already bought everything and are now selling it back to me at a markup.
They've front-run your order, not with insider information in the classic sense, but with information they got from the guaranteed latency built into the system by regulation. It was a sure thing.
And Ronan Ryan discovered another layer to this. The HFTs were building something called latency tables.
Yeah, this is brilliant and terrifying. They were creating these huge databases that correlated the travel time of an order down to the nanosecond with the specific brokerage firm that sent it.
So they could tell, just by the timing, who was trading.
It was like a poker tell. They could say, oh, that order took 2.1 milliseconds. That's RBC's routing pattern. They always buy in huge blocks. They could predict how the rest of that massive order was going to be spread across the other exchanges.
They just needed the odds tilted slightly in their favor.
That's all. They knew if a big buyer was in the market, the price was likely to go up, and they could position themselves to profit from that move at the direct expense of the buyer.
What's even worse is that the brokers themselves were complicit in this, often without even realizing it, because the exchanges started paying them.
Kickbacks, they're called rebates. The exchanges were desperate for trading volume, so they'd pay a broker a fraction of a penny for every share they routed to their exchange.
Which created this massive conflict of interest. A broker might send your order to an exchange that paid a higher rebate, even if that exchange was physically farther away and would result in a worse price for you, the client.
Your own broker was selling you out for a fraction of a penny per share. The system was structurally corrupt.
So Brad and his team, he's brought on Rob Park, John Schwal, and now Ronan Ryan. They move from understanding the problem to trying to quantify the damage.
They build a tool they call Thor. It's designed to execute trades in a way that neutralizes the HFT advantage.
And they run tests. They'd simulate buying, say, 10 million shares of Citigroup and measure how much money they saved when the HFTs couldn't front-run them.
And the savings per share seemed tiny, like less than 0.1%. You'd think it was insignificant.
But you have to apply that tiny number to the massive scale of Wall Street. When they took that small tax rate and applied it to the entire U.S. stock market's daily volume, which was about $225 billion a day.
The number becomes staggering, over $160 million.
Every single day.
Every single day. Removed from the pockets of investors and put into the pockets of the high-frequency traders, it's a constant, massive transfer of wealth from capital to speed.
And it was an invisible tax. No human could possibly see a loss that happens in microseconds across 13 different computers.
As Brad said, people are getting screwed because they can't imagine a microsecond. The speed was an invisibility cloak for the crime.
This realization triggers a moral crisis for Brad and his team. They see the system as fundamentally hostile to investors, and they decide the only way forward isn't more regulation, which would just create new loopholes.
Right. The only way was to build their own solution, a new stock exchange rooted in fairness and transparency.
The revolt begins. They decide to build the Investors Exchange, IEX. The goal was to eliminate the middleman, to neutralize that one single advantage HFTs had, unequal speed.
So the design challenge was, how do you do that? How do you make it so that market data arrives for everyone at the exact same time? How do you make your own exchange faster at seeing what's happening than the HFTs who are trying to game it?
The answer was so simple and so brilliant and entirely physical. It was called a speed bump.
Brad's team, especially a guy named Don Bollerman, who knew the guts of the NASDAQ system, they calculated the exact amount of time they needed to defeat the arbitrage.
They knew the HFTs were exploiting the time it took for an order to travel from the first exchange to the farthest exchange.
And that farthest exchange was the NYSE data center in Mahwah, New Jersey. The maximum travel time to get there was 320 microseconds.
So, to level the playing field, they just rounded that number up slightly to exactly 350 microseconds.
Every single order that arrived at IEX would be intentionally delayed by 350 microseconds before it was processed or sent up to the other markets.
And that tiny delay was revolutionary. It made the HFT's main strategy completely useless. By the time their speedy algorithms got the signal from IEX and tried to race ahead to the other exchanges,
it was too late. The 350 microsecond delay meant IEX had already seen what was happening everywhere else and priced its orders correctly. The arbitrage window was slammed shut.
And the way they built the delay is the best part. It wasn't software. It was physics.
The magic shoebox.
The magic shoebox. They literally coiled 38 miles of fiber optic cable and stuck it in a box in their data center.
That's it. They created a physical delay. They use distance to force the speed of light to work for fairness instead of for exploitation. It's just an incredibly elegant solution.
Of course, the establishment, the big banks, the other exchanges, they were furious. IEX was a direct threat to their most profitable business.
So as soon as IEX launched, they faced massive resistance. The big banks refused to send orders to them. Some HFTs even tried to sabotage the system, sending tiny bait orders to try and figure out their internal logic.
It was a real battle. But then came a huge turning point, the Goldman Sachs pivot.
This is where the whole story shifts. Goldman Sachs, one of the biggest players on the street, decides to back
And
IEX.
it wasn't really a moral decision, was it? It was more of a strategic one.
It was a rational calculation. The executives at Goldman realized they could never actually win the pure speed race. There would always be some small, specialized firm that was faster.
They saw that their real long-term advantage wasn't in nanoseconds, it was in client trust and stability. And this HFT predation was eroding trust in the whole system.
So they looked at IEX not as a threat, but as a solution to an industry-wide problem that was hurting their reputation. They decided to flip the switch and start routing their customer orders to IEX.
And that was a massive signal to the rest of Wall Street. It legitimized the fight. It showed that this had the potential to, as the book says, take billions from Wall Street and return it to investors.
And eventually, the data proved Brad's original theory was right, that the investor's order was the news.
This is the obelisk of activity. A data specialist at IEX named Josh Blackburn created this amazing visualization. He mapped out market activity across all the exchanges, millisecond by millisecond.
And what he found was that activity wasn't smooth or random. It was concentrated in these massive spikes, a tall, thin obelisk of trading that rose out of a desert of almost no activity.
And here's the kicker. That obelisk, that huge spike in trading, it occurred exactly 350 microseconds after an investor's order first hit an exchange.
It was the smoking gun. It proved visually that the investor's order was the trigger for a feeding frenzy. The 350 microseconds was the exact time it took the HFT predators to get the signal and execute their front-running trades.
The investors weren't just participating in the market, they were the punch bowl at the party.
And IEX's initial results showed the concept worked. They traded over 500,000 shares their first day and quickly got to 50 million a week. It proved that if you give investors a choice, they will choose a fair market.
But the whole story just highlights how incredibly hard it is to fight the system, to fight that inertia. The conflict of interest with brokers getting paid by exchanges was so profitable and so entrenched.
They weren't just fighting a bad system, they were fighting a revenue stream. The system was designed from the ground up to benefit the middleman, even at the client's expense.
And it speaks to a kind of misdirection of talent, too.
Absolutely. The IEX team noted the irony that so many of the engineers at these HFT firms were brilliant scientists, many from Russia, because the Soviet education system was so focused on high-level math.
So you have these geniuses who could be solving huge global problems.
And instead, they're on Wall Street, building systems designed to exploit loopholes and shave nanoseconds off a trade to make a risk-free profit. It's an incredible waste of intellectual capital.
Which means IEX's mission was bigger than just a technical fix. It was a cultural one, to create a market where doing the right thing was actually rewarded.
And it brings you back to that historical cycle of regulation. One of Brad's guys, John Schwal, found that basically every major market injustice in history came from a loophole in a regulation that was designed to fix a previous injustice.
Red NMS was created to ensure the best price for everyone.
And in doing so, it created the latency loophole that HFTs could drive a truck through. The new technology didn't get rid of the middleman, it just made him invisible and 1,000 times more profitable.
Which is the beautiful paradox here. The technology, like the magic shoebox, now exists to get rid of that parasitic middleman entirely, to connect buyers and sellers directly and fairly.
But the instability and that hidden $160 million a day tax, that remains the price the market is willing to pay to prioritize a few milliseconds of speed over actual fairness.
So the question isn't technical anymore. The solution exists. The question is moral. Does the market actually want to be fixed?
And that's what we want to leave you with. A final thought to chew on. Given that the history of financial regulation shows that every fix seems to create a new, more complex problem, and given that a simple, elegant, technological solution now exists but is largely ignored by the big players because it cuts into their profits, what does that tell you about the real purpose of modern finance?
Is the primary goal long-term health, stability, and trust? Or is it maximizing a short-term informational advantage, no matter what instability that creates for the rest of us?
That's a deep dive that takes a lot longer than 350 microseconds to think about.